The following information relates to Lumon Industries during the first quarter of 2025, given unit sales, sales price per unit, variable manufacturing cost per unit, variable selling costs, and how many units were being produced for January, February, and March. Additional data on January 1, there were 2,000 units on hand. The cost for these units is consistent with January's costs. Fixed manufacturing overhead is $3 per unit and is applied to units of product on the basis of production volume. The $3 is based on budgeted production of 14,000 units per month. Cost of goods sold is adjusted monthly for any over or under applied fixed manufacturing overhead. Lumon Industries uses FIFO inventory flow. Work in process inventories are not material and are to be ignored. Fixed selling and admin expenses total $22,000 per month. Prepare quarterly income statements using absorption costing and variable costing. I noted when we were doing Chapter 8 material that sometimes it's really good to look at your inventory unit flows just to see what's happening there, and then to look at a per unit product cost under variable and absorption, just so that you've got those organized in advance. It doesn't ask you for them in the question, but that's how I'm going to start. So if I look at my inventory in units, we've got January, February, and March. I want to do opening inventory, add production, and subtract sales, and that gets you to closing inventory. In Part A, they said on January 1 there were 2,000 units on hand. Production for January is 15,000. February 18,000, March 13,000. Sales at the top 12,000, 14,000, and 18,000. So we're going to subtract that. And then we can calculate ending inventory. So for January, ending inventory is 5,000 units. That of course goes up and becomes February's inventory opening, which gets you to 9,000. Again, that goes to opening, which gets you to 4,000. This inventory jumps around a little bit as to what's sitting there, but the next things I would usually do is my unit product cost. And again, this is product cost, so you don't want to be including your selling and admin there. So usually you do direct materials, direct labor, manufacturing overhead, but I just want my variable. And in this question, they just say variable manufacturing cost per unit. So this is going to be your direct materials, direct labor, and variable overhead otherwise, and then fixed. And this will be your fixed overhead. And so for each month, I would usually do my absorption and my variable, absorption and variable, and absorption and variable. For this question, it doesn't really matter if you do this because it's exactly the same every month. And then they even tell you opening inventory is all based on January's data, so it doesn't matter. I'll talk about this in just a sec. Now, usually I would have said, hey, you take the $3 per unit and multiply it by the 14,000 units, because that's based on budgeted, is what they said in the question. But they said, fixed manufacturing overhead cost is $3 per unit and is applied to units of product on the basis of production volume. The $3 is based on budgeted production of 14,000 units per month. So in essence, they're budgeting for 42,000. Cost of goods sold is adjusted monthly for any or over or under applied fixed manufacturing overhead. So they're applying overhead based on this every month. So it's not like you're using actual amounts. They're always going to be using this predetermined overhead rate to apply it. So if you wanted to think about it, that's why I left it at 3. If you're looking at, hey, actual fixed overhead compared to applied fixed overhead each month, the actual is going to be the $42,000. The applied will be based on number of units produced every month. So we are applying based on this $3. In January, we produced 15,000 units, February is 18,000, and March is 13. So for applied overhead for January, you're looking at 45,000. For applied overhead for February is 18,000 units, so therefore 54,000. And applied overhead for March is 13,000 times the 3. So your unit product cost is not changing because you're using this application and you're just applying it based on a predetermined overhead rate, which is different than the other questions that we did in Chapter 8. But if you look at this, if it's over or under applied, you've got 3,000 over applied in January. You've got 12,000 over applied in February. And you've got 3,000 under applied in March. But the $3 of fixed overhead is just going to be in inventory for the product. The product cost of the items on the balance sheet and right now in the income statement is going to be, if you're doing the absorption costing, is going to be based on the $8 because we're applying the $3. And then the question said, any over or under applied is in essence close to cost of goods sold every month. So this difference is going to go on our income statement every month. So we're actually in this question not changing how much our overhead is, fixed overhead is in our inventory on the balance sheet every month. We're fixing it to the income statement. So it's a little bit different of a question that way. Didn't say you had to do this over under until you do the income statement, but it did say cost of goods sold is adjusted monthly for any over or under applied fixed manufacturing overhead. So these amounts here are going to have to go through the cost of goods sold section in our income statement. But you definitely wouldn't, for this question, take the 42,000 and divide it by 15, and therefore that's your product cost for January, and divide it by 18, and that's your product cost for February, because that's not how they're doing the product cost. The product cost they're doing is based on this predetermined overhead rate. All right, so let's actually get to the income statements. So under absorption, we're going to do sales, and we will then subtract our cost of goods sold. So sales, and I'm going to do them all together, January, February, March. Sales for January, 12,000 units, and each month they're selling them for $12 per unit. Sales for February is 14,000 times 12, and sales for March, 18,000 times 12. So 144,000, 168,000, and 216,000. In this case, because our product cost, unit product cost didn't change from month to month, we can just use the short method for our cost of goods sold. We don't have to do opening inventory and all of that. So 12,000, and under absorption, we said it's $8 per unit. 14,000 times 8, and 18,000 times 8. but we need to adjust our cost of goods sold for the over or under applied overhead. To get to adjusted cost of goods sold. And I'm just going to take my numbers from above because I've already calculated it there. Over applied means we're going to deduct it from our cost of goods sold. Under applied means we're going to add it. So we get $93,000 for January, $100,000 for February, and $147,000 for March. And now I can take the sales minus our cost of goods sold to get our gross profit. Which gets you to $51,000, $68,000, and $69,000. From there, we can do our selling and admin. They tell us our variable selling cost is $2 per unit. That's right in the table. So 2 times the 12, and times the 14, and times the 18. So you get 24,000, 28,000, and 36,000. And then our fixed selling and admin in Part D, they tell us is $22,000 per month. So our total selling and admin, probably don't have to subtotal, but gets you to operating income of, this is the gross profit minus the selling and admin, so $5,000, $18,000, and $11,000, as long as my math's all correct here. I'll just put dollar signs while y'all are scribbling. And then from there, we can do our variable for the same 3 months, January, February, March. And you could add this up to do a full quarter, like just to add it as a total if you want. Variable, we're going to start with sales again. I'm just going to copy the numbers from above. So 144,000, 168,000, and 216. That way, if I'm wrong for both of them. It's consistent. Under the variable statement, we will do, okay, or call it a contribution margin statement, whichever you would like. We will take sales and then we will subtract our variable costs. Variable costs being our product costs, so cost of goods sold, and then our selling and admin costs that are variable. We already noted in our table above that every month it is the same, and it's $5 for our variable costing, so $5 per unit. Each month, again, that didn't change, so you can just use the short form. What do we have? Sales of 12,000, sales of 14,000, and then sales of 18,000. Selling and admin variable, you can just pull it from above if you wish, because it should always be exactly the same for both statements, or remultiply it out if you wish, but it is $2 per unit sold. Those are our variable costs. We can add them up. To get you to your contribution margin. We don't have to close any over or under applied overhead here because that's fixed overhead that we were applying, and we don't have that in our cost of goods sold under a variable costing statement. So 60,000, 70,000, and 90,000. And you don't have to put your dollar signs, don't worry about it. And then we'll subtract off our fixed expenses. And we have fixed overhead, and then we have fixed selling and admin. Fixed selling and admin was the 22,000. Again, exactly the same as the previous. Fixed overhead, well, that's the $3 times 14,000 units to get yourself to that full amount. You don't want to look at applying it here. That would be wrong. You want to look at, in essence, what the actual amount is. We add up our fixed expenses. You get 64,000. $64,000 and $64,000. So that gets you to your operating income, or in this case, a loss, because for January, 60,000 minus 64 is a loss of 4,000. 70 minus 64 is income of 6,000. And 90 minus 64 is 26,000. Didn't ask you to, but you could do a reconciliation if you wanted. So I'm going to start with my variable costing, which is a loss for January. 6,000 for February, 26,000 for March. We'll add fixed overhead in ending inventory. We'll subtract fixed overhead. Fixed overhead and opening inventory, and that will get us to our absorption statement. Fixed overhead and ending inventory. Okay, ending inventory for January. And again, this is sometimes why it's nice to do the little thing up here at the top, because then you can just pull your numbers. Ending inventory for January is 5,000. Opening inventory is 2,000, and $3 is our fixed overhead amount. And it's always going to be that. So 5,000 times 3, and this is 2,000 times 3 for January. And so you get 15,000 and 6,000. So you end up with $5,000 for your absorption income. February ending inventory. Again, if you were to scroll to the top, we had ending inventory of 9,000 units at 3. This one you can just carry down if you want. Don't have to recalculate it. And for March, we have ending inventory of 4,000 units. So you can compare those to your absorption statement, and it is what you get for absorption.